So in this video, we are going to go through the guaranteed rates with different life insurance companies in respect to whole life insurance products that comply with the new 7702 update. Now, we're also going to touch on the impact that this will have on MEC limits, and here's what I will state. Since the 1980s, all life insurance companies in respect to whole life insurance had a guaranteed rate of 4%. Most companies, that is, which made it very easy from a MEC limit standpoint, as the MEC limits would be the same with almost all of the companies out there, or very similar. With this new change, and the fact that companies have the choice to select a guaranteed rate between 2 and 3.75%, will result in different MEC limits with different companies and different products. So having awareness on this point is very important for consumers and agents. So let's get into it. We're going to start with 3 companies and where they have selected their guaranteed rates to fall on products. So we will begin with Guardian, one of the major mutual companies. They have a dividend interest rate for 2021 of 5.65%. The guaranteed rate that they have filed for all of their whole life insurance products will be 3%. So what that means is if I go back to the guaranteed rate of 4%, if I had a dividend rate of 5.65%, what would that result in terms of my surplus being? If I have a guarantee of 4, the surplus would be 1.65%. Add the two together, I'm now at 5.65%. So the same thing occurs in respect to the guaranteed rate of 3%. The difference is I have a higher surplus portion now. Guaranteed rate only of 3% plus 2.65% on the surplus to give you a total dividend interest rate of 5.65%. Why that is important to be aware of is in respect to the non-guaranteed values, this setup actually offers more potential. On the guaranteed values, not as attractive as the guaranteed rate of 4%. New York Life has a 2021 dividend rate of 5.8%. They have filed all of their whole life insurance products at a 3% guarantee. So very similar to Guardian, I've got a 3% guarantee. For 2021, this means I have a surplus crediting rate of 2.8%. The two together give me that 5.8% rate. Mass Mutual has done things a bit differently. So Mass Mutual has a 6% total dividend interest rate. Now with that said, they have filed different products at different guaranteed rates. So this is important to be aware of as the MEC limits will be adjusted, and we're going to touch on that next. But for example, their 10-pay product, they have filed a guaranteed rate of 2% with that product. Now their 15-pay product, 2.5%. Their life paid up at 65 and their 20-pay, they have filed a 3% guaranteed rate, which is the same as Mass Mutual, with Guardian and New York Life with all of their products. And then their Legacy 100 and High Early Cash Value products, they filed a 3.75% guarantee, which is not that much different from the current 4% guarantee. So those products could look very attractive in terms of cash value. And the same premium dollar, here's what I'll add, is when you see a higher guaranteed rate on a whole life insurance product, the higher the guaranteed rate is, the same premium payment will purchase you more life insurance. So really how the company positions this is if they are attaching a higher guaranteed rate to a particular product, that means a $10,000 premium with the L100 may purchase you, call it $1 million in death benefit, whereas a $10,000 premium with a 10-pay may only purchase you, call it $600,000 in death benefit. So the guaranteed rate has a direct relationship on the death benefit and purchasing power there. Now with all that said, most people that we work with say, hey, I don't care about the death benefit. I'm interested in the cash value. How do I maximize that? And what do my guaranteed cash values look like based on these rates? That is a fair question. So the guaranteed values are still attractive because the insurance expenses have come down, but here's what I want to touch on. The guaranteed rates and MEC limit impact. This is very important here. So we've got our cheat sheet. Here's what I want to touch on. If we've got an age 40 male and a product with the current guaranteed rate of 4%, a guaranteed rate of 3%, and then 2%. 2% is as low as they can go. 4% would be an old product that we could still purchase for the rest of 2021. If I want a $100,000 MEC limit the needed death benefit for an age 40 male will differ. For example, at a 4% guarantee, I would need approximately $2.8 million in total life insurance to obtain a $100,000 MEC limit. Now, if I am comparing that to an illustration perhaps with Guardian at a 3% guaranteed rate, what you'll find is if you are a 40-year-old male and you said, I want to be able to pay in $100,000 per year, I want the minimum expenses, minimum death benefit, you would only need, for that same $100,000 MEC limit, just north of $2 million, $2,050,000. Now, if we kick the guaranteed rate down to 2%, what happens here? The death benefit's even lower. We've got 1.5 million. It's actually a little bit lower than that. It's closer to 1.4 to 1.45 million. I just rounded here. My point is for that same 40-year-old male, if I have a product that carries a guaranteed rate of 2%, I only need a $1.5 million death benefit to obtain the same $100,000 MEC limit. This is good to be aware of if you are interested in a maximum cash value policy. Because when it comes to policy design, the premium and PUA limits are exactly the same as they've always been. Minimum premium, 10%, 90% into PUAs. Companies have not made any adjustments there, which is great. But I do want to be aware of the total death benefit needed so I can really push down my costs. Let's look at a couple of examples here. So what we're going to look at is first a product with a 4% guarantee. This is on a 40-year-old male. Here's exactly what I want to touch on. So this is a 10/90 split. And let's look at the total death benefit. So here we're at about 2.9 million. It's a little bit higher than the 2.8. But here's what I want to touch on. From the company's illustration software, there's my MEC limit. So we are at a $105,000 MEC limit based on that death benefit of $2.9 million. When we set up a policy for the minimum death benefit, which is what so many people ask for, you may have asked for that or may be thinking that, how do we minimize that death benefit, or what is it based on? It's based on the total MEC limit. What has a direct relationship to the MEC limit on a life insurance policy is an individual's age and total amount of life insurance. So call it the age and total death benefit. I will add, however, that gender plays a role as well. So a male versus a female, you'll see different death benefits equate to different MEC limits. Point here, this is a product with the old guaranteed rate of 4%. Let's look at an example with a 2% guarantee. So same company, same product. Look at your death benefit. 1.5 million, a little bit higher. Circle that in the event it's a little small, about 1.5 million. Here's what I want to touch on. Same age 40 male, which we can see right here. MEC limit, $106,000. So a little overinflated, which means if we wanted a clean $100,000 MEC limit, I would just pull that death benefit down a little bit. We're right there though. Typically when we design policies to pay in for a long period of time, we're going to overinflate that MEC limit to prevent a MEC, and that's what we did here. But my point is now we've got a product here with a 2% guarantee on the same age 40 male. So we had age 40. I neglected to really highlight that in the first one. So age 40 male, ultra preferred. Going back to the last example, age 40 male, ultra preferred. And this is with the $2.9 million death benefit. MEC limits are almost identical with these two examples. One's a 4% guarantee, the higher death benefit. The next one, the $106,000 MEC limit, $1.5 million death benefit. So I need less death benefit for the same MEC limit. And then let's look at a 3% guarantee. Oopsie daisy. There we go. So I had to screenshot this from the software because it's not on the full illustration. But what you will find here, age 40 male, you can see that here as well. Total death benefit, $2,050,000. I realize that may be small. $2,050,000 on the total death benefit. age and death benefit have a direct relationship to the MEC limit, and there we go. In case that is small, it reads 101,680, so just north of $100,000. So the interesting piece here is different death benefits now exist with different companies to obtain the needed amount of MEC space. So again, if you are designing a policy or if you're requesting a policy where you want to cash flow it up to $100,000 per year, you can still commit to the minimum and add more discretion, so I can pay 10 only and then add up to 100 of my discretion. You can still do that, but when we look at this, we need to be aware of the different companies and products that exist so we can make an informed decision. Where it will really help if you are in the industry is when we have those unique situations where someone is earning $100,000 per year, but they've got a lump sum of $1 million and they say, hey, I want to pay this $1 million in over 4 years, 250 grand per year into a policy. Those situations are sometimes challenging for the reason that the maximum death benefit one can obtain, so if it's a age 30 individual earning $100,000 per year, and he wants to pay in $250K per year for 4 years because he's moving a portion of his lump sum that he has in cash. Perhaps he sold real estate, maybe it was an inheritance, whatever it might be. The important thing to note is from a life insurance company's perspective, what they're going to look at is our income times, call it 30 in this case, which would come out to what? About $3 million. Based on the old limitations, that may only get me a MEC limit of maybe $100,000 at best, where I want to pay in $250 per year, and the company will not approve a death benefit of this size based on my income, or I should say a death benefit that handles a $250,000 MEC limit. So I may need, I'm going to retract what I just said there, or back up, I should say, I might need $7 million in death benefit to be able to pay in $250 per year. It'd actually be more than that. Couldn't do it with the old rules, or it'd be very, very difficult with that 4% guarantee. With a lower guarantee, the same maximum death benefit I'm approved for now obtains me a greater amount of MEC space. So that gives me an advantage in that respect. So know this is a decent amount of information. If you have any questions, please feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.